Hello everybody, my name is Joe Bisping, and in this video I'm going to show you the basics of commercial multifamily underwriting, and I'm going to show you what gurus promise to show you after they charge you thousands and thousands of dollars, but then don't actually show you. I'm going to do it for free here on YouTube, so if you like this video and it brings a lot of value to you, go ahead and like, subscribe, all that stuff, all that good stuff, and share it and comment below. But if the idea of investing in a large commercial multifamily deal like this as a passive investor piques your interest, check out my email below in the description and you can shoot me an email and I will send you some deals maybe in the future that you can review and see if maybe they'd be a good fit for you if that's something you're interested in. All right, so let's just jump right in. Today I'm going to show you an example of a 21 unit. We're going to pull it right off the line and we're going to go through the process of just doing some basic underwriting for this commercial multifamily property. I'm going to go over some details. We're going to see what kind of spreadsheet I'm using, and hopefully this will help you a lot. All right, so you can go online. You can find deals all day if you want. I'm not saying they're going to be good deals, but you can find deals online. You can go to LoopNet, you can go to Crexy. So I found this deal on one of those websites and the broker sent me the information, so we're going to walk through it right now. You're going to see a lot of different types of underwriting files out there on the internet. This is just the one that I use. You can purchase them, you can make your own, you can do all these calculations manually if you like, but we're going to walk through this one. Most underwriting files are going to have different tabs. The first one you're going to see is your dashboard. And like I said, we're going to pull a deal right from the internet. You're going to see the whole process, so you can go do this on your own as well. First thing you're going to do is you're going to put in the asset information. So let's just start there. So the property that we found, I'm going to show you right now. Okay, so I reached out to a broker online on one of those websites and got the offering memorandum. And for privacy's sake, I've just taken some screenshots of that memorandum and I'll show you some pictures of the property. As you can see here, this is the property. It's made up of 21 units. And you can see there's two different style buildings here, but it's all one property. All next to each other, and here they are. We're not going to put an actual complex name here because I'm going to keep it private, but we'll say sample. All right, and we're going to say, let's just say it's built in 1965. We're not going to put an address. We're going to do the unit count. It's 21 because that's what it is. Now the asking price I know is $2 million, so that's what we're going to put here. And then for the purchase price, you can always start off by putting in the actual asking price. Okay. Oops, not 20 million, 2 million. There we go. You can always put in the asking price, and then we can work back from there. And it's going to start to kick you out some information, but we're going to fill this all out first. So the first thing is just like, okay, how many units? What's the name of the property? How much are they asking? And if there's any earnest money, sometimes there is none, but sometimes there is. So we'll put 50,000. If you don't know what that is, just look it up and you'll find out about earnest money. So far, we're getting an idea of the debt stack here. We'll come back to that. So we're going to put in some information here. Here we can do, so these are going to be your GP, which is also known as your sponsor returns. And there's different fees you can add in here depending on the deal. Every deal is different, guys. Every deal is structured very differently, and they have reasons for the fees and maybe reasons you wouldn't do the fees. Right, so we're going to hold off on that. We may add some fees here depending on how we want to structure the deal, but that's what's so unique about this industry, guys, is you can structure the deals in so many different ways. One thing that's important that you need to find out is what kind of debt product can you get for the property. But let's just go ahead and make some assumptions here just for now while we're taking a basic look at a property. And if it seems like there might be something here, we can always go out and start shopping for what kind of product we can get. So let's just assume we're going to have to put 25% down. And the rates right now around 7.5%, interest only 24 months. All of this can change. Amortization of 25 years. Okay, this is stabilized debt. Very basic, guys. So that's what we'll keep on here. Next thing we need to know is what's the cap rate for this area. And if you don't know what a cap rate is, you need to look that up. If you'd like me to do that in another video, explain what a cap rate is, I'm happy to do that. Just leave a comment below and I'll do that. Now there's a difference between your market cap rate and your sale or purchase price cap rate. But we'll go over that another time. But you need to find your market cap rate. One of the things you can do, and I'm going to show you a really cool trick here, a free website you can go to. It's called Cap Rate Index. Right? You can search the zip code and it will give you an average cap rate for that area. And here it's saying it's about 8%. So that being known, let's go ahead and put 8% here. So that's the current market cap. And let's see, if we were going to refinance it, we would also have it at 8. And let's say, what's the cap rate going to be itself? We're going to make some assumptions here, but let's just be a little conservative, say 8.2. and we're gonna sell in 5 years. Most of these deals are gonna be 3 to 5 years. Okay, so let's start there. Then we'll come to your total equity shares, and this has to do with your LP or GP, or if you're just gonna do a JV, or if you're just gonna do this deal all by yourself. Just depending on how you're gonna structure it is gonna affect how we're gonna change this. But before we do that, we need to go to our actuals tab. And in the actual tab, you're going to see where you're going to see your actual expenses and income, and then your pro forma. So I've already filled this out based off the information from the broker. I'll pull that up for you right now. Okay, here we have the expenses. This is from the offering memorandum. We go ahead and just take this information as it is for face value, and we go ahead and transfer it over to our spreadsheet, which I've already done. But this is what you'll generally see, something like this. So we've got our expenses from the offering memorandum. I filled that in here. It'll give us, hey, this is our expense ratio. This is a 29% expense ratio, which is really low. So that's questionable. But I'll come over here. I'll transfer what I think will pretty much stay the same. And then I'm going to make any adjustments that I need based off my due diligence that I know about the area. Taxes and insurance are usually going to go up. So I'll increase that. You want to make your assumptions here. You want to get a really good, as close as you can, accurate idea of what your true expenses will be for you as an operator, because everybody does things differently, right? If I was going to, if my plan was to own or operate and I didn't have a management company take care of the property, well, then that would definitely affect my expense ratio, right? But me, I'm not going to do that. I'm not going to live there, and I'm not going to own or manage it. I'm going to have a company come out and do that for me, a property management company. So let that reflect how you're going to do it here, and that's going to give you an idea. Next, you want to do your unit breakdown. So this is primarily 2-bedroom, 1-bathrooms, and we have about 9 3-bedroom, 1-bathroom. So you want to put down the unit count here. You want to put the current rents right now, your current rents, average. So you want to average your current rents. You don't have to sit there and figure out, like, you don't have to put all of them in. You just want to get your average. Okay, here we have the rent roll. So the rent roll is really important, guys. Anytime you want to run the numbers on a big deal, you need the rent roll. So this is your current rent roll. So here we can see the unit breakdown as far as the unit numbers. Here's the unit breakdown as far as bedrooms and bathrooms, and then the current rent. And this is what the broker might make a recommendation on what they believe the market rent is. Now, all of this you have to verify as far as market or pro forma, but this is the actuals right now. So what you can do is you can add these all up and calculate the average rents. Okay, so we've done that. We have the average rents here. We've got the unit count, and it's going to give us our current income on a monthly basis. Okay, and down here, it's going to kick out our current net operating income, which is really important. So this is the current net operating income. If there's any other income, you would put it up here. You can also put your vacancy rate up here as well. Now, next, what we need to do is say, hey, what can we get for rents? What do we think we can push these rents? Like, what is market rent? Are we at market rent currently, or is there a little bit of room to push? So one thing you can do is you can go to Rent-A-Meter. Here I put in the zip code, and you can search the property and see what the average rents in the area is. And now it says the average is $837, median is $980. Now what I do know is that for this property, it's more of a kind of like a townhouse. I think they even have some like garage space. So there's garage doors. So I know we can get a little bit more than that. And the broker also said that their performance, they thought in the area would be $925 for the 2-bedroom, 1-bathrooms, and then $1,200 for the 3-bedroom, 1-bath. So that's what we're going to make our assumptions here. Now I've got some other data that could help me determine that, but for this sake, on a basic level, you can do that. It's absolutely free. You can go and do that. Best thing to do is go knock on the doors in the area. Ask around. Well, hey, what are you guys paying for rent? Go stop at some restaurants. I've done this. Ask the waitresses and waiters, hey, do you guys live around here? What do you think of the area? How much do you pay for rent? And you'll get some really good answers. And the next thing you're going to do is we're going to take a look at our CapEx. CapEx right now, so you've got pretty much your interior CapEx, which is your renovations, right? Capital expenditures, and then also your exterior CapEx. So let's take a look at those pictures again. Let's take a look at the interior pictures. All right, so we're looking at the interior pictures. There's not a lot to go off of here. This is just what the broker sent me. As you can see, I mean, they don't look bad, but clearly they could have some updating, right? I mean, if I look at some of the units, not horrible. These aren't the nicest appliances, and the cabinets look okay, but they're generally going to show you the nicest unit in their pictures. I mean, we got a pink toilet there, it looks like. kind of outdated. It needs some updating. So on a very basic level, we need to do some CapEx interior. So let's just assume, hey, this would be a low CapEx budget. Let's say $3,000 per unit. So it's gonna put us at like a $63,000 CapEx budget. Now we have no idea, we haven't been to the property, and generally you don't go to the property until you do some underwriting. But looking at the pictures, I don't see anything major outside, but you'll probably find some stuff. So I'm not gonna put anything for exterior CapEx right now, but we'll definitely do some for interior. All right, now we're back at the dashboard. So, like I said, we put in the asking price, and we assumed that the purchase price will be also the asking price. Okay, so we're going to make those assumptions. Purchase price is going to be the same as the asking price. So if we just take a look at it right now, let's go ahead and move for how we're going to structure this. Let's assume we structured this where I was just going to come in and buy it outright with cash. Like, so I have my own cash. I'm going to come in. I'm going to buy it. What do my returns look like? Okay, I'm going to come in with my own money. I'm going to do the stabilization. I'm going to push the rents, any renovations. I'm going to fix all that stuff, and I'm going to push it and try to get to pro forma. This is what my return would look like. So I'm going to have to bring total of $723,542, and this is with some assumptions. And that's my assumption. I had 25% down at this rate, all those assumptions. But right now, if I did that at $2 million, my total equity multiple is only a 1.45, which means I'm not making a huge return, right? The cash on cash is only just under 7%. Not great, especially when I'm doing all the sweat equity and I brought the capital. I mean, I could take my capital and put it in somebody else's syndication and make a better return than that. I could 2x my money and get a higher cash on cash and not do any of the sweat equity. So right now, $2 million purchase price, not looking good at all here. I'm not going to structure that deal anyways. Let's assume we're going to bring in let's do a JV. Say we want to do a JV, which is like a joint venture. So I want to bring in another partner. And say I have the experience, but you have somebody who doesn't have any experience but wants to learn how to do multifamily, has some money, they can bring the money to the table, and we can do that. Or maybe we all bring a little piece of the pie. Like maybe I bring a little bit of money, they bring a little bit of money, we get 5 people in there. I have some deals that I'm on currently right now where there's 5 of us in a JV, and we all bring a piece to the table to get the deal done. So let's go ahead and do that. So let's say it's 50%. Okay, so you can see when we make it like a 50-50, as if we were going to do some like a JV structure, it just basically breaks up the difference in the LP and the GP returns for the capital that's brought, and then the GP returns for their 50%. So your 50% equity and their 50%, but it's all getting split because it's a JV. Right now, it's still the same returns. Doesn't look very good at all, right? Not good. Let's see, refi exit. I mean, we're making like 83 grand on all of our work. Not worth it at all. Profit and loss, let's take a look here. If we look at our profit and loss, we're making a little bit of cash flow, but not enough to justify. So we're looking at an equity multiple of 1.23. Not good. Okay, so we know immediately we need to drop down this price. So let's go ahead and drop it down. It's not surprising when you pull up a deal off the internet that they're way overpriced. They usually are. So if we're doing a 50-50, we're still at, like, say I dropped it down to 1.5 million, right? We're still only at equity multiple of 1.87, which is still not really a great enough return for your capital, right? Because we still have to bring $571,000 to be able to close on this deal. And that's with a really low estimate for CapEx, okay? Now we're starting to get into a better profit here for doing that. But remember, this is JV and we have to split these profits. And it's still not looking pretty good. If we really want to make this deal hit that 2x equity multiple, we really got to be closer to like 1.3. Maybe a little bit less. A little bit more. Let's go 1.4 as a JV. Okay, so now we're getting into like an equity multiple of, 2x equity multiple. This is a JV. This is looking a little bit better. Okay, this is a little bit more reasonable for the amount of money that you're bringing in your return. Looking at our profit and loss, we would be bringing in, pretty good cash flow, right? This is divided amongst your entire JV team. So you have a total cash flow of about 89,300, depending on the first year. We go up to 94, 77. So it changes as you go, but this is divided amongst all of your JV members. And remember, this is accounting for their money that they've invested in the deal. So although it seems like a decent cash on cash, or it seems like you're bringing in a decent amount of return, but you have to understand the amount of return for the amount of money that you're investing is what you're looking at. So I think if it was me, I would try to structure this as more of a JV. So that's where I'm going to do like a 50%, 50 LP, 50 GP. This is basically saying, hey, this is all 50-50. So imagine like all the returns are going to be split amongst anybody who's on the JV team. And your JV team could be 2 people, it can be 5. I'm in a JV with 5-6 other people right now on a different deal. But if that's the case, you can see we got to drop the purchase price down quite a bit, right, to make it make sense for the amount of money we have to bring to the table plus our sweat equity, right? So we want to get a decent return for the actual capital we bring, but we also want to get a good return for our sweat equity too, right? Because this is the total profits to our manager, which would be everybody on the JV. So we all have to split this. So if there's 5 of us, you can see it kind of thins out pretty quick. So, I mean, that's one way you could do it. I mean, if there's less people, it's not bad. But let's do this. Let's say we want to bring in a debt investor. So let's say we only give them, let's bring in an investor. So I'm going to do this deal on my own, almost on my own. I'm going to bring in an investor, and I'm going to give them 10%. So we're going to call that a pref. So a pref is basically paid out. It's any cash flow paid out before anybody else gets paid. Okay. So let's set this up like a pref. Let me give them like 5% LP share, but mostly debt, right? This is so creative, guys. You can do it so many different ways. But we're gonna say, hey, this is debt. So this is debt at 10%. It's a pref or preferred return, and it's what they get paid before anybody else does, any of the GP teams. So basically, I'm trading cash flow for equity. So now, as an investor, as a GP, I own 95% of the equity. So the GP would see a higher return overall, total profits to the manager. And if I'm going to do that, maybe we put a little fee on here. Maybe we say like, because I got to eat a little bit too. I'm giving up all the cash flow, but I got to eat. So maybe I'll put like a 2% fee there. It's called an acquisition fee. You see this, it's not uncommon. And the reason is you can have months wrapped up in a deal and get no return, especially if it's, a debt structure like this. You don't see a lot of cash flow. I mean, you can go years before you actually see a return. So that's why you see some of those fees up front to help the GP team survive, right, to eat during the life of the deal. So let's take a look at it here. So I'm going to drop this down a little bit more. We're at like 1.4. Let's go 1.3. We're looking at like 61K unit, all in at like 71K unit. Now I think this is getting to be a bit more reasonable. Like, so if I can bring in a debt investor at 10%, let's see what my cash flow looks like. All right, so here in the P&L, you're going to see your cash flow, what that looks like. So right here, we've got the preferred return paid to that debt investor. So they're going to see the majority of the cash flow. Okay, so they're going to have like 53K. They're going to get each year. They're getting that 53K. Okay, so they will also get 5% of the GP return, so they get another $2,000, and then there's another $39,000 left over for the GP team. So I make about $40,000, a year. So that's not bad. I mean, that's some good cash flow off this deal at this purchase price. Now we're getting something that it's really worth doing, and we could see that, hey, I'm getting 39, 45, 29. 34K. I mean, this is some decent returns. So at this structure, that looks pretty attractive, right? If you could find an investor, it doesn't look like we're going cash negative or anything here. Okay, guys, so you can see this is very creative stuff. So there's many different ways that you can structure a deal to make it work for you. A good deal for somebody else may not be a good deal for you. However you need to do it to make the deal work, you can be very creative. Either way, I don't think that this deal is going to pan out for $2 million in any single way at all, for me, in my opinion. So you're definitely going to have to offer a less offering price than what they're asking to make it work. So to me, this property is worth more around 71K per unit all in, based off the market data and what I know about the area. And this was an assumption of really low amount of capex, which is usually a lot higher than you think. And these are coming from properties that have been online usually for a while. So this is a cool way to learn and practice underwriting, but also to get to know some brokers online. As you go and do that, you can respond back to them with what you find. So this is a cool way. This is the basics of commercial multifamily underwriting. I hope this was helpful. If you'd like me to go into more detail about any specific part of this or anything as far as multifamily investing goes, let me know. Put it in the comments below. and I will make another video about it. And if you're interested in investing passively or maybe partnering on a future deal, comment below or check out my email in the description below. Shoot me an email, and now we can connect and see if maybe we can do something together. And I can send you some deals to look at in the future to review. See if it'd be a good fit for you to invest as an LP investor. But I hope you enjoyed the video. I hope it brought lots of value to you. And until next time, take care.